All right, let's jump right into this explainer and honestly, completely shatter a common beginner's illusion about building wealth. A lot of people think they have this perfectly protected, well rounded portfolio just because they own a bunch of different company names. But today, we're going to look at what actually goes into a resilient wealth building strategy. Because if you want to protect your capital and grow it across completely different economic seasons, we've got to look way beyond just stocks. So here's our visual roadmap for today. We'll start with the true diversification myth, move on to how bonds act as your stability anchor, then we'll look at REITs, which is basically painless real estate, and finally, we'll tackle gold, probably the most misunderstood asset out there.
Let's kick things off with part one, the true diversification myth.
Ask yourself right now, does owning 20 different stocks actually protect you when the entire market crashes? Think about it. If you own Apple, Tesla, a local bank, and a massive retail chain, you might feel super diversified. But when a global recession hits or interest rates suddenly spike, the stock market as a whole just tends to drop. Those 20 different stocks, well, they're all sitting in the exact same economic boat. And when that boat starts taking on water, they literally all go down together. This brilliantly illustrates the difference. Beginner diversification is just buying multiple stocks, but true diversification? That means filling fundamentally different buckets that respond completely differently to the economy. We're talking about spreading your wealth across entirely different asset classes. You want assets that have totally different jobs in your portfolio, so when one goes down, another one holds steady or maybe even goes up. That's how you build a real fortress around your wealth. Okay, moving right along to our second section, bonds, which really serve as your stability anchor. So here's the crucial point. Bonds are simply loans. They provide a safer, albeit, slightly slower alternative to stocks. See, when you buy a stock, you're buying a tiny piece of ownership in a business. But when you buy a bond, you're essentially playing the role of the bank. You're lending your money out to a government or a large corporation. In return for your cash, they promise to pay you regular interest and then eventually give you your original money back on a very specific date. It's safe, it's steady, and it's totally predictable. Now, take a look at this. Notice this universal rule of opposites mapped out here? You absolutely must memorize this if you want to time the bond market. Bond prices move inversely to interest rates. Why is that? Well, think about it. If you own a bond paying 3% interest and the central bank raises rates so all the new bonds pay 5%, nobody's going to want your old 3% bond unless you drop the price, right? Conversely, if interest rates fall, your older, higher-paying bond suddenly becomes extremely valuable and its price shoots up. When you actually step into the bond market, you generally have two main flavors to pick from. You got to choose between the absolute ironclad safety of government securities or the higher 4 to 8% yields of investment-grade corporate debt. Government bonds, things like U.S. Treasuries or UK gilts, are backed by the full faith and credit of the government itself. They're your lowest risk option, hands down. Corporate bonds carry a little bit more risk, so naturally they pay you more. But here is a quick pro tip. If you go the corporate route, stick to investment-grade companies rated BBB or above by rating agencies like Moody's or S&P. Let's see how this actually builds into an actionable strategy. The winning move here is to shift your capital from stocks over into bonds in the late summer phase of the market, right when market optimism hits that greedy 75% threshold. Look, when the stock market is just booming, everyone's euphoric, and prices are peaking, that is the summer season of the market cycle. That's exactly when you want to trim your stock profits and park that capital right into bonds. Because when the inevitable market correction hits, your bonds will hold steady and give you that crucial ballast. All right, let's shift gears to section 3. REITs, or what I like to call painless real estate. Real estate investment trusts, or REITs, are these incredibly unique corporate entities, and they come with a massive legal advantage for you as an investor. By law, they are actually required to distribute at least 90% of their taxable income right back to you as dividends. Imagine owning a fraction of a massive shopping mall, and 90% of the rental profits just automatically get deposited directly into your brokerage account. That is the true power of a REIT. These trusts are absolute passive income machines, typically yielding anywhere from 5 to 10% a year. And the best part? They let you easily own diverse, globally renowned properties without ever having to fix a leaky roof at midnight. You aren't just buying suburban houses. We're talking commercial high-rises, massive hospitals, logistics warehouses, and even data centers. And if you want top-tier quality, you really need to look at Singapore's S-REITs. They're globally renowned for strict regulation and fantastic yields. We're talking heavy hitters like CapitaLand, Mapletree, and Ascendas. It really is real estate without the headaches. Now, the secret time and trick here is to buy your REITs when interest rates compress their prices and overall market optimism is really low. Remember our rule of opposites from earlier? It applies here too. When interest rates are high, REIT prices generally get pushed down and market optimism drops below 30%. Guys, that is your buy zone. You lock in a ridiculously high dividend yield, and as interest rates eventually start to fall, the value of those REIT properties recovers. So you end up getting both passive income and capital appreciation. A real win-win. Finally, let's move on to Section 4, gold, which is undeniably the most misunderstood asset out there. I'm sure you hear this popular narrative literally all the time. Gold is the ultimate safe haven. It always goes up when markets crash, right? People treat it like this magical ultimate store of value. But assuming gold always rises when markets fall can be dangerously misleading. Some of that narrative is true, but a lot of it isn't. It is definitely not a magic shield, and if you treat it like one, you could severely damage your portfolio's growth over the long haul. Let's look at a staggering 30-year reality check. If you bought gold at the 1980 peak, which was around $800 an ounce, you then suffered an agonizing 20-year wait going absolutely nowhere just to break even. It wasn't until around the year 2000 that you actually saw your original money again. Meanwhile, in that exact same 2-decade stretch, stock investors gained 1,000%. Just imagine sitting on a flat 0% return for 20 years while the rest of the world compounded their wealth tenfold. Unbelievable, right? The reality is, gold actually operates on massive, multi-decade cycles. It's driven by inflation expectations, the strength of the US dollar, and unpredictable geopolitical risks. It is absolutely not a consistent safe haven. Timing your entry into gold is just as critical as timing any individual stock. If you accidentally buy gold at the top of a 20-year high, you might literally be waiting an entire generation just to see a single dollar of profit. Therefore, our absolute strictest pro tip here is to cap your gold allocation at just 5 to 10% of your overall portfolio. You really have to view it strictly as extreme scenario insurance, rather than some big growth engine. It's there for the worst-case scenarios like hyperinflation or a total currency collapse. You buy a little bit, you tuck it away in the corner of your portfolio, and you honestly just hope you never actually need it. Never buy it at a 20 or 30-year high, and remember, it's an insurance policy, not the engine driving your wealth forward. So take a really hard look at your asset buckets today. Because true wealth isn't just about picking the right stocks, it's about holding the right asset classes when the economic seasons inevitably change. Are you heavily overexposed to just equities? Do you actually have your stability anchor planted in bonds? Do you have that sweet passive income flowing in from REITs? And is your gold allocation strictly kept as a small, manageable insurance policy? Look, the economic seasons will change, and a winter will eventually come. The only real question is, will your portfolio be ready?